The London silver market stands as the world's most important hub for physical silver trading, a position it has held for decades. Here, in the heart of the city, billions of dollars worth of silver change hands every single day, shaping the global market. Unlike a traditional trading floor bustling with shouting brokers, London's silver market operates as a sophisticated network of major banks and financial institutions. They trade directly with each other in what's known as an over-the-counter or OTC market, where deals are made privately, away from public exchanges. At the center of it all is the London Bullion Market Association, or LBMA. This organization sets the rules, enforces standards, and ensures the market runs smoothly. Thanks to the LBMA, London has become the global benchmark for silver prices, with its daily price fix influencing contracts and trades worldwide. Every day, hundreds of millions of ounces of silver are bought and sold, with most mining contracts and industrial deals around the world using the LBMA price as their standard reference. The sheer scale of these transactions is staggering. Trust is the foundation of this system. Banks and institutions hold vast reserves of silver in heavily guarded London vaults, backing up trades and providing the liquidity that keeps the market moving. These vaults are the silent guardians of the world's silver. For decades, this system worked seamlessly, offering stability and reliability, not just for investors, but for the entire global economy. The London market became a symbol of trust and efficiency. But over time, the market evolved. Instead of trading only physical metal, more and more deals involved unallocated silver, essentially digital promises or IOUs, rather than real bars stored in a vault. This shift changed the very nature of silver trading. This innovation allowed trading volumes to soar far beyond the actual silver held in vaults. It increased liquidity and made trading faster and easier, but it also introduced new risks that few fully understood. The danger? If too many people demanded their physical silver at once, the system could break under the pressure. The promise of silver was only as good as the ability to deliver the real thing. For years, this was considered a hypothetical risk, an unlikely scenario. But everything changed in October 2025, when the world finally discovered what happens when the promise of silver collides with reality. The London market's foundation, once thought to be rock solid, was about to be tested like never before. The eyes of the world turned to London, waiting to see if the system would hold. The question loomed large. Could the world's silver hub actually deliver when it mattered most? Would the vaults open, or would promises go unfulfilled? The answer would send shockwaves through the entire financial world, forever changing how we think about trust, risk, and the true value of silver. On October 10, 2025, the unthinkable happened. The London silver market, the world's largest and most trusted hub for silver trading, froze without warning. For decades, it had been the beating heart of global silver commerce, a place where billions of dollars changed hands daily. Buyers who had been counting on physical delivery were suddenly told there was no silver available at any price. Vaults that once brimmed with metal now stood empty, and the usual hum of activity was replaced by stunned silence. The market, famed for its deep liquidity and reliability, simply stopped functioning. Screens that once flickered with trades now showed nothing but zeros. This wasn't a technical glitch or a temporary pause. It was a total breakdown of trust and supply, a crisis that no one had truly anticipated. The free float of deliverable silver dropped to zero. Not a single ounce was offered, despite mountains of outstanding contracts and desperate buyers. Banks, fearing a run on their reserves, refused to part with their metal. This sparked panic among investors, industrial users, and even ordinary citizens, who suddenly realized the metal they thought they owned might not exist. The cause? A sudden, overwhelming surge in demand for physical delivery, as contract holders lost faith in paper promises and rushed to claim real metal. The system, built on the assumption that only a fraction would ever demand real metal, was overwhelmed by a tidal wave of requests it could not meet. Analysts called it a default in all but name. The market's core promise, physical delivery, was broken, shattering confidence worldwide. The freeze exposed a dangerous disconnect between paper claims and physical reality, revealing just how fragile the system truly was. Trust, the market's lifeblood, evaporated in a single day, leaving participants in shock and disbelief. The world's silver engine had stalled, halting industries and sending shockwaves through the global economy. The consequences were just beginning to unfold. The financial world was left reeling, uncertain if the system could ever recover, and bracing for what might come next. The October crisis revealed a paradox. London's vaults held nearly 800 million ounces of silver, yet none was available for delivery. Most of that silver, over 80%, was locked away in exchange-traded funds, owned by investors and untouchable by the banks. Only about 140 million ounces remained as free float, but even that wasn't offered to the market. Large holders, fearing collapse or betting on higher prices, refused to sell. The result, a market that looked deep and liquid on paper, but was actually a shallow pool. The illusion of abundance was shattered. The real tradable supply had vanished. Paper contracts were no substitute for real metal. The vaults weren't empty, but the available silver was gone, and that distinction brought the market to its knees. The crisis exposed the fragility at the heart of the bullion banking system. With London's market frozen and panic spreading across the globe, a massive emergency rescue was launched almost overnight. The world's financial leaders scrambled to prevent a total collapse, knowing that the consequences would ripple far beyond London. China, the US, and Switzerland coordinated an unprecedented effort, injecting over 50 million ounces of physical silver into London's system. Shipments arrived under heavy security, with every ounce counted and tracked. This was no act of charity. It was pure self-preservation. A London default threatened to unravel global markets, putting banks, investors, and even national economies at risk. The infusion provided a temporary buffer, allowing urgent deliveries to be made and restoring a fragile sense of calm. For a moment, it seemed the worst had been averted. But beneath the surface, the core problem remained. Paper claims on silver still far outnumbered the real metal available. The system was still dangerously out of balance. The rescue was just a patch on a leaking system, a quick fix that did nothing to address the underlying flaws. China's involvement underscored the seriousness of the crisis. As the world's top silver refiner, its support was absolutely crucial. Without China's silver, the rescue would have failed. Yet the emergency supply was quickly absorbed, vanishing almost as soon as it arrived. The market was left dependent on a constant, uninterrupted inflow of new silver just to function. Now, London operates on a razor-thin silver in, silver out basis, with no margin for error. Every shipment is critical, every delay a potential disaster. Any disruption, whether in mining, shipping, or a sudden spike in demand, could trigger another freeze, sending shockwaves through the financial world. The system is more fragile than ever, living day to day on borrowed time, with everyone aware that the next crisis could be just around the corner. The world's silver hub is now a high-wire act, teetering above disaster with no safety net below. Every day is a balancing act, and the stakes have never been higher. The emergency silver injection restarted London's market, but didn't fix its core weakness. The free float is now just 50 million ounces, a tiny cushion for a market trading hundreds of millions daily. Billions of ounces exist as paper promises, but only a fraction is real. The system is a classic fractional reserve. It works only if confidence holds. But after October, more people want real metal, not IOUs. Banks face massive liabilities if silver prices spike, risking insolvency. The market's survival depends on a steady flow of new silver. Any disruption could cause another, even worse, freeze. Every day, London gambles that enough silver will arrive to keep the system afloat. Two key indicators, backwardation and lease rates, reveal the market's stress. Backwardation means buyers pay a premium for immediate delivery, signaling desperation for real metal. Since the crisis, silver has stayed in backwardation, showing the shortage is ongoing. Lease rates, the cost to borrow silver, skyrocketed to nearly 40%, a sign of panic. Even after the rescue, rates remain historically high. These signals are the market's fever chart. The patient is still in critical condition. The shortage isn't abstract. It's a daily reality. More people want real silver than the system can provide. The London market's vital signs are flashing red. The silver market is split between London's LBMA and New York's COMEX. London is the physical market. Contracts mean real metal must be delivered. COMEX is mostly a futures market, where contracts are settled in cash, not metal. London's failure to deliver is a true default. COMEX can change rules to avoid one. The October crisis hit London because it's where the world gets physical silver. The breakdown in London undermines trust in all paper silver, even in New York. The two markets are different, but deeply connected. Now, everyone is questioning whether their paper claims are backed by anything real. The crisis in London is forcing a global reckoning. The London crisis has transformed silver from an industrial metal into a strategic asset. The US has officially added silver to its list of critical minerals, recognizing its importance for industry, energy, and national security. Ensuring a stable silver supply is now a matter of policy. China, the world's largest silver refiner, is restricting exports starting in 2026. Every ounce leaving the country will need a special license. China is prioritizing its own reserves, signaling a shift toward national control of silver supplies. The breakdown of trust in Western paper markets is driving countries to secure physical metal within their borders. The global market is fragmenting as nations race to build their own stockpiles. Silver is now a pawn in the geopolitical game, a resource to be controlled, not just traded. The era of easy global access to silver is ending. The world is entering a new age of competition for this critical metal. The October 2025 crisis shattered trust in the old system of silver pricing. The world is moving away from centralized price discovery based on paper promises. Now, price will be set where the metal actually is, in regional hubs, not just London. The mantra is clear: if you don't hold it, you don't own it. Physical silver is in demand, and prices are rising as buyers scramble for real metal. The future will likely see different prices in Shanghai, Zurich, and Dubai, reflecting local supply and demand. The single global silver price may be gone for good. For investors, owning physical silver has never mattered more. As nations secure their own supplies, the public's access to silver will shrink, and prices will find a new, higher level. The crisis wasn't the end for silver, but the start of a new chapter, one defined by scarcity, strategy, and real metal.